All these measures that we're hearing from central banks and governments right now, does it buy them enough time to stabilize these markets until we see some sort of pivot from the Fed?
Well, the hope is that you hang on just long enough until the Fed stabilizes and signals it's done. And we may actually get to that point next week, right? We had famously last week a suggestion that maybe the Fed could signal a move towards a smaller increments of rate hikes next week after they meet. And so if you just get to that point, then, of course, it's enough. If we see the Fed come out with a strong message next week saying we're going to do another, big rate hike, then of course it's hard for these interim measures really to gain long-term traction. That's the risk here. I have to say though that fundamentally in these markets across Asia, we're actually not looking at compromised financial systems. We're looking at very robust financial systems. This is a problem of adjusting market pricing for FX, for asset prices. We're not back to where we were, 10, 12 years ago during the global financial crisis, at least in this part of the region. So even in Korea, yes, credit spreads are widening out. The government comes in with measures, but it's not the same systemic risk as we saw before.
And should we still expect weaker currencies, though, even if it is not such a bad thing as what we saw in 96, 97, just given what the Fed is doing and these trade is slowing, for example, current accounts are still blowing out?
That's still the bias, right? Because we get two challenges in Asia. On the one hand, we get the Fed raising interest rates, and in China, growth is not really gaining traction. We really need both to kind of play to our strengths, which is Fed needs to stop tightening at some point, and we need to see more indications that China's economy is gaining traction. Once you get that, FX will stabilize, and you get that, Asian financial markets will start to find stability. We may be a few months away from that, but I think going to year end, yes, the bias remains for dollar strength.
I mean, the Fed keeps, of course, raising rates, but it's also about defending its credibility. In that defense of credibility, does it warrant putting the economy into a very slow growth trajectory, if not a recession? And could we see a political backlash against this as well? I'm not just talking about the US, but globally speaking.
Well, you got to do what it takes. You got to.
But for what reason, though? You see that the ultra have won a single mandate or a dual mandate, which collide.
Well, ultimately, though, we know that lower inflation or stable inflation is better for long-term employment, long-term growth. So if you have to bring down inflation expectations. And I still think the Fed will go as far as it needs to go in order to bring inflation expectations back down. And that may potentially include a U.S. recession. Now, the backlash you talk about, that's very real. And that's something that often happens with a lag, right? It only happens at the ballot box 1 to 2 years later
just
that
like
you see the back, just like interest rate moves. Yeah. So very, very tough job for central bankers here. But do you have a choice? Can you allow higher inflation just to avoid the political backlash? Not if you really want to do your job, which is long-term stability requires lower and stable inflation.
If China reopens, does that change the whole inflation trajectory as well? I wonder, if March we're going to see some sort of signs of maybe reopening or maybe them at least adjusting that COVID-0 policy, could we see inflation start peaking up, oil prices start peaking up again?
The hope is that actually at that point global inflation will have declined enough that a reopening by China, a reacceleration of China's economy is not going to give us a huge inflation impulse. So there might be a gentle rebalancing here in the global economy, but a very fine line, right? But we already seen in the goods price sector, goods price pressures are coming off, right? Goods demand is coming off. There's still some pressure in energy price markets. There's still a bit of pressure in wage market services, but you already see goods price pressures coming off. So then China accelerating is not necessarily all too bad. It will put a floor on the growth without necessarily leading to a huge jump in inflation. But it's going to be tricky to get the balancing right here.